Welcome to the program. I'm Ini John McQuarrie. We'll start from the global space as usual, telling you that oil has eased on Friday, heading for their first monthly drop since November as uncertainty over global economic growth and fuel demand from Washington's tariff threat, as well as further signs of a U.S. economic slowdown outweighs supply concerns. The more active May, we see a slipped 31 cents, that's about 0.4% to $73.23. Same value, same percentage for WTI at $70.05. Both benchmarks are on track to post their first monthly decline in 3 months. U.S. President Donald Trump said that he's proposing 25% tariff on Mexican and Canadian goods will take effect in March, the 4th day of March. There's also an extra 10% duty on Chinese imports. Also weighing on investor sentiment is the jobless claims that jumped more than expected in the previous week in the United States, while another government report reiterates that economic growth slowed in the 4th quarter of 2024. Let's stay in the oil space, but here in Nigeria, I believe by now price slash has started being implemented at the pumps, at least those pumps or those companies, retailers that buy their products, Petrol, that is PMS, from Dangote. Of course, it's to the joy of the consumers. Well, let's try to understand where this is coming from with energy expert Kelvin Emmanuel joins us from our Abuja studios. Hi, Kelvin. Good afternoon.
Good afternoon, Ini. How are you today?
So I can see that you're happy, and I'm sure a lot of consumers are happy, Kelvin. But it would be better to know where this is coming from, this latest slash from Dangote refinery. Is it coming from the global reduction in the price of crude, or is it domestic? Can you help us understand that?
Well, first of all, the reaction that I've seen so far, I saw some quotes and statements by some importers who said that Dangote is trying to run them out of business. And I remember last year, the same people said that he was trying to monopolize the market. And furthermore, I saw that they also said that they were pleading with him to raise the price back up, so that they will not lose money, because it looks like some other people are going to him to take products and they're going to lose money because their landing price is way above the price that he's currently offering the market for at gantry. And it's quite interesting because, you know, Nigerians are watching in amazement and wondering how a few group of importers will be asking the largest commercial domestic refiner in Nigeria to raise its prices, considering that inflation is biting very hard. Headline inflation today is 34.8%. I don't believe the CPI rebasing that was done recently. Food inflation is nearly 40% and is even more higher in some parts of Nigeria. So it's quite interesting that they will say that. But given as it may, like the factors that are really driving the reduction in price, you see that crude oil prices are easing because there is the U.S. government is engaging with Russia on the possibility of removing the oil and gas embargo on Russia, settle the war in Ukraine, and bring Russia back to the SWIFT system of global banking that has about 12,000 banks with headquarters in Belgium, and possibly have Russian banks be able to, you know, raise LCs for Russian oil and gas companies, Upstream, Gazprom, and the likes that lift product out of Russia to the global markets, basically readmits them so that you don't have third-party trading in the Indian Ocean. That is driving the price of crude oil prices on international markets. You know, Trump has also called for OPEC to work with his partners, both in OPEC and OPEC plus Saudi Arabia and the likes, to see that crude oil prices come down. But, you know, it's a tricky situation on the global markets because the break-even price for shale is a little over $60. So the U.S. government will want to maintain crude oil prices anywhere between $60 and $65 per barrel. And then you also look at Nigeria. You see the fact that in the last couple of weeks, the impact of the compliance with the circular the CBN has released last year on the harmonized system of reporting on net open positions, where some tier 1 banks onshore were holding a lot of FX liquidity and speculating on it. The introduction of the matching system that Bloomberg manages has basically, led to more efficiency and transparency in the foreign exchange market, and the volumes of foreign portfolio investors bringing in liquidity into the FX market, Nigerian Foreign Exchange Market, MFM, has increased. So you can see that the CBN is using that, part of that, to draw down its outstanding obligations on forwards. Recently, Deloitte okayed for the remaining $2.4 billion of $7 billion that were owed on from dividend and capital remittances to be paid. So CBN is prioritizing and drawing that on that. So there's a lot of liquidity in the market right now, and you can see that the exchange rate is trending down. And, we've always said that, listen, after the government decided it was going to comply with sections 205 and 206 of the PI on the regulation of the petroleum, downstream petroleum markets in Nigeria. And people went and said, oh, the government wants to kill them. The government wasn't trying to kill them. The government was trying to move to more efficiency. Two things came in and started controlling the price of petrol in Nigeria. Number one was the price of crude oil and the exchange rate, especially after Dangote started, So now you have a more efficient market, and you have a situation where basically Dangote is having to compete against importers whose quality of product into Nigeria you cannot verify and does not meet up with the acceptable standards as scheduled in sections 317 and 11 of the Petroleum Industry Act. So the regulatory framework and structure on how the midstream sector in Nigeria, which only came alive in 2024 after Dangote started producing white transportation fuels, is another conversation entirely. But these are the immediate near-term factors, driving the prices. And you can't take away from the fact that Dangote currently, I'm aware, he has hit 600,000 barrels per day processing capacity. And as interesting is doing that, because if you look at the fact that the schedule of allocation for crude oil under the so-called Naira-based crude swap dropped to about $62,000 per barrel, 62,000 barrels per day, as against what the government was saying. And Dangote has had to import about 12 million barrels of crude in February, and is going to import the same or more in March, because he's moving now from 600,000 barrels per day to 650,000 barrels per day, which will be full capacity. You look at the fact that the economies of scale has kicked in. The real economics of scale on him being able to tap into what they call positive cracking margin. It was benchmarked at anywhere between 500 and 550,000. It's crossed that threshold, and the scale has kicked in, and he's able to, move a bit around on prices. But he's operating a high volume, high turnover, low margin business, and the margin he's making as a refiner isn't as fantastic as people think it is. For him to be able to go down without crude oil prices coming down further or the Naira strengthening further from where you have it today.
All right, so the thing is, we see, and as you've noted, President Trump is working on restoring the full supply of Russian oil into the global space, among others. So what this would mean is that the price of global crude oil will stay down. And while that seeps to lower prices at the pump, it also means lower revenue for the government, because of course we know the target for the budget is 75. How do you think we can bridge this difference, assuming that it stays at 70, 72, which is what we're saying, and as you noted, the US should be targeting about 60, then it should be good for consumers right here. But how do we bridge that revenue difference that we may not hit?
Well, you've asked a very important question, and the reason why this question is important is because, when I saw the 2025 appropriation bill, and I saw the crude oil price benchmark at about $75 per barrel and an estimate of 2 million barrels per day for 2025, I said, to a few people privately that these estimates were not realistic. I don't know if the president had economists in the room, his presidential economic advisory council to advise him on how the outlook for 2025, considering the political reality in America, was not exactly feasible. Considering the realities of the upstream sector in Nigeria, his outlook was not feasible. But there are two major important and two important things that we need to pay attention to. And also going forward, how do you navigate this problem? Number one, Mr. President has to, I don't know if he signed the appropriation bill into an act yet, but if he hasn't, he has to revise his focus on the, number one, the price of crude, the benchmark price, and number two, the daily production target of 2 million barrels per day. I don't think it's realistic. You see, for you to increase crude oil production in Nigeria, you need to pay attention to shutting wells. Yeah, you need to pay attention to stranded assets. You need to look at the onshore. For example, Renaissance, that bought the assets of Shell, I think has about 573 wells, if I'm not mistaken. There are issues around decommissioning, abandonment, remediation costs that forms legal liabilities that you need to pay attention to. I think there needs to be like a second look at the commercial terms for the framework in the upstream sector that precedes companies opening FID, final investment decision. It's my view that when you model those commercial terms based on global best practices, that some of the incentives the government is giving is a bit too generous. It leads to excessive tax breaks for the operators. These are not the problems they have, because the number one driver of investment decisions in upstream sector is the recovery factor for oil and gas. Recovery factor for oil is 20, recovery factor for gas is 80%. And when you have a situation where the recovery factor is not higher than the hurdle rates as benchmarked in other markets, they don't open investment decisions. Today, the challenge is not just getting crude oil to subsurface, it's getting crude oil from subsurface to terminal. So these are structural issues that needs to be tackled, as against just giving excessive incentives and breaks to the companies. You've seen a few decisions. Bonga North, you expect to do 300 million barrels estimated ultimate recovery over a period of 10 years, but it won't achieve first oil until 2029. So the hope is on the onshore, how Seplat is able to navigate the challenges Mobil has had onshore, and how Renaissance Consortium is able to navigate the challenges Shell has had onshore, especially in River State. I also think the government needs to realize that Dangote is able to solve the total consumption of Nigeria on a daily basis. Nigeria doesn't consume more than 32 million liters. So you might have to come and ask NMDPRA to do like an audit of the actual daily consumption of petrol in Nigeria. Now, then the government also needs to, look at sections 317, 7 to 8 of the PIA on giving import licenses to marketers if the daily consumption in Nigeria is reached by the domestic refiner in Nigeria. Because they don't use cowries to import petrol. They use scarce FX that should go to other very important things to import petrol. So if you slow down on importation, you're going to see definitely that the FX market will improve, because there will be a reallocation of that FX demand to other priority sectors in the economy. And it will help, because a situation where you have scarce FX being used to import petrol that is already available in Nigeria leads to pressure on the rates. And when you have the Naira dropping steadily, inflation goes up, interest rate goes up, companies are not able to borrow. They run to commercial papers and corporate bonds. You don't see a lot of activity in the equity capital markets. That impacts on decision of finance available for companies to be able to produce. When production is lower than demand, prices go up. It's the cycle. The government has to realize that this is the cycle and this is the way it works. The government also has to pay attention to public finance, not just cutting spending, but also increasing revenues, which is the reason why, the public hearings this week at the National Assembly has been great. And I have hope that when the tax bills are passed, you're going to see, after 12 months, a revision up of the tax and non-tax revenue to GDP ratio, with Nigeria, the worst performer in sub-Saharan Africa, up. And, that will greatly impact on the macroeconomic outlook for Nigeria, especially as it impacts on issues like the usual default rating of the government and its ability to raise cheap capital on the international and international debt capital markets.
All right, Kelvin, thank you so much for that, taking us all through the connecting chains in the economy from oil and to the Naira and all. Thank you so much for sharing your perspective with us this afternoon.
Thanks for having me.